Once inflation comes down, the banks don't have to raise interest rates as much. And the stock market is going to love that. They're going to say, oh, great. We're looking forward 12 months. Now the cost of borrowing for all these companies is going to be less. Therefore, the profitability will be higher. Home prices should stabilize. Therefore, the consumer would return back to spending. Hey guys, Omar Khan here from Theta Trading, and welcome to our latest video. And today's video is going to be about inflation and what does it mean for us investors. So let's talk about what's going on in the markets right now. So what's going on in the markets right now is this nasty word called inflation. You can see it everywhere. You go to the grocery store, you see it. You go to the gas pump, you see it. You see it everywhere. Prices are up. Now, what does that mean? That means the value of each dollar you have is now worth less. And the reason this happened is because during COVID, the central banks really printed a lot of money to help us out of that nasty issue of people not working and economic activity coming to an absolute standstill. We are starting to see the effects of that now. Not starting to, actually. We are seeing the effects of that now. Not as much back then, right? Back then, we're just printing money. Now, what's happened? The prices of all sorts of asset categories have gone up, along with a global supply chain disruption, which is still here. Now, these are all bad things about the market, but we're going to look at evidence. What does the evidence tell us? Because the stock market, as we've talked about many times, is a forward-looking mechanism. It is looking forward 12 months, and it's saying to itself, is inflation coming down? Because it's pricing in today what it thinks is going to happen in 12 months from now. And if it gets wind that inflation is coming down, that could be really good for the stock market. So far this year, the stock market, as I speak here at the end of June, it's been a rough ride. Now, I'm going to reference a few things from Canada in terms of inflation. I am a Canadian, but inflation is persistent throughout the world. I'm also going to reference a lot of global commodities. So let's take a look at the first slide here. It says Canada's inflation. This is from the Toronto Star. Canada's inflation rate is punishing now, but it will drop to half its current level by this time next year. Now think of that. So we had a 7.7% inflation reading in May. In the United States, it was a little bit higher than this. This is the highest inflation we've had in 39 years. Now these are the key factors driving inflation. Retail sales, gas prices, grocery stores, grocery prices, and look at the last line here. After about 2 decades of relentless price inflation, Toronto house prices have dropped as much as 20% in recent weeks. Now, that's not something that's specific to Toronto. That is specific to a lot of different cities. Now, you're starting to see why, because interest rates are going up. Therefore, people can afford less home. That brings down the value of homes, which means people will buy less stuff, therefore lowering inflation. Now, I know it sounds kind of weird, but the idea is you want the economy to slow down. What the Federal Reserve and the Bank of Canada are trying to do is something called a soft landing. They're trying to increase interest rates as much as they can to slow down the demand and therefore slow down the amount of things people are buying, but still not yet crash the economy into recession. So let's take a look at some more evidence. So housing prices are going down, not just in Toronto, but all across the world and the United States in particular. Inflation is running high as it's been almost in 40 years, okay? But we can see finally there's a definite decline in home prices, okay? So there's a buyer strike among prospective buyers finally taking a look and balking at outrageous prices. Okay, so real estate is a lagging indicator. It is going to react after the fact. And after the fact, now interest rates have gone up and up and up. And all of a sudden buyers are saying, wow, man, if I have a mortgage this high, I can't afford it. Therefore, I can't pay for this thing. And also the same house that I was looking to sell in order to get into this home, I can't sell for the same price anymore. This is going to take a while to go in through the economy. It's going to take a while. You can see here, it's going to take probably another year and a half for the real estate cycle to work itself out. But what could happen, what we think is going to happen, is interest rates may not go up as much as anticipated. We're going to talk about it a little bit later on, okay? So now let's take a look at another issue we talked about, supply chain issues. The same applies to another inflation driver, the global supply chain gridlock. Delays in shipping at superports in China and on North American West Coast are now easing considerably. We've talked about not being able to get stuff. Well, that's because a lot of times the ports and the shipping and the supply chains have been completely messed up. But now we're seeing this is starting to ease up. It will be a few more months before the ports are operating at full capacity and our goods, once again, abundant supply at reasonable prices in Toronto stores. Now, again, that applies to stores around North America. We want to see that things that people are ordering are able to be brought to them, right? If you want to buy a PlayStation 5, well, you should be able to get it. And because you can't right now, you've seen a lot of wonky stuff like used car pricing way higher than it's ever been. Because again, we have a supply chain issue, so there's less demand, less supply, more demand. These are all issues affecting inflation, and the stock market hates inflation. But we can start seeing this is starting to come down. Here's headline inflation should continue to outperform. Now, this is from Credit Suisse, driven by ongoing strength in energy prices. Core PC is already likely peaked for this cycle, and we expect ongoing moderation in the second half of the year. The near-term outlook for inflation is less uncertain. So what this is saying is that inflation still may be a little bit hot for the next few months, but they really expect it to cool off in the second half of the year. And again, you're starting to see this. You're starting to see this with lower home prices, used car prices coming down. I'm talking about a few more things. So core PC, price consumer expenditure. This is the amount of money people are spending on stuff. We can see from this graph here, the projections year over year are higher, but you can see it's starting to fall down. As Credit Suisse says, second half of the year, they expect this to go down. Why is this good for the stock market? Well, once the stock market says inflation's not as bad, that means interest rates don't need to rise as much. Therefore, people can start putting higher valuations on stocks once again. Okay, there's less uncertainty. What the stock market hates is uncertainty. It doesn't know how bad inflation is going to get. And that's why you've seen a huge sell-off this year. So the stock market is really looking for some good news, a catalyst as we call it. And that catalyst could be lower inflation and slowing of the economy down. It sounds counterintuitive, but it's not. Now, here's another one. Credit Suisse again. We expect headline ISM in manufacturing. That is all manufacturing done. Now, if this number is above 50, that means the economy is expanding. If it's below 50, that means the economy is contracting. You can see in this graph here, you can see periods where it does go below 50. That's 08-09, which was a nasty, nasty recession. And you can see in March of 2020 during COVID, again, a huge, huge decline. When that number gets to around 50, that means the economy is if it's below 50, the economy is contracting. If it's above 50, the economy is expanding. So we can start seeing this number is coming down. It fell to 52 in June, lowest reading since summer of 2020. Again, that's showing that manufacturing is slowing down. That's what these banks were trying to do. Okay? Again, that is evidence-based. Now here's the next one, commodity prices. Commodity prices have declined over the past 2 weeks. Bloomberg Commodity Index declined 11%. Since the recent peak on June 9th. You can see it's been on a torrid pace pretty much since the end of the pandemic. This is what's leading to a lot of our inflation. You've probably seen it. Lumber prices, copper prices, all these different things, metal prices, all higher. The cost of building stuff higher. But we can start to see now it's coming down. Now again, what does that mean? Does that mean it's going to be good for inflation? The economy is slowing. Housing prices are going down. Commodities are going down. What does that mean? That means we're more than likely going to get lower inflation going ahead, which is exactly what the Bank of Canada and the Federal Reserve wanted to do. Okay. Now, here's actually the market pricing for Fed funds rate change after the February 2023 FOMC meeting. That's Federal Open Market Committee. The probability of rate hike in February of next year has collapsed. Okay. Oftentimes, when they raise interest rates, they raise them way more than they need to. This could be one of the situations. So the market's saying here that, the rate hikes, we'll probably get a few more this year, but the probability of one next year has really, really started to decline. Okay? Now, here's some more stuff. The Fed funds future spread. Okay? Now, this is kind of boring. I know, I get it. The market sees the Fed cutting rates by nearly 60 basis points. That's 0.6%. Between quarter one of next year and quarter one of 2024. So what this is saying is that markets may raise, the banks may raise rates too high, therefore putting the economy into a worse position than was necessary. And when that happens, they're going to have to cut rates. So what the Fed funds future spread is telling us is they may have to cut rates by the first quarter of 2023. So we're going to see how much more they increase this year, and then they might have to cut. Let's take a look at the longer-term inflation. Though U.S. inflation has been unexpectedly high, inflation swap data indicate that longer-term inflation expectations haven't seen a similar shift upward. This suggests that the market believes the Fed will get inflation under control. That is the St. Louis Fed. Now you can look here, the 5-year number here, okay? 5-year forward inflation number here. And that is, you can see it is reasonable. Inflation is expected to be around that 2.5% range, which is exactly where the bank, the Federal Reserve wants this number, okay? So now let's take a look at this next graph. This is something that happens. It's kind of wonky. We have midterm elections and election years that are a bit weird. The markets get choppy, very choppy, in fact. Again, this is evidence-based. You can see in 2018 we had an inflation concern, and then we had a quick recovery, okay? I remember that. I've been investing for almost 25 years. They all feel like they're at the end of the world, but they never are. The markets have always returned to an all-time high. That's one thing you have to remember in your head. Now, 2020, we had that sharp correction, which was COVID. That was horrible. But the markets recovered quickly. And again, now this year, we have another inflation fear from all the printing that was done in 2020. Now, this again is a midterm election year. But the Democrats have to make sure the economy is on solid footing and the stock market's doing reasonably well. Otherwise, they are going to get decimated in the elections. Okay? Now, we're never meant to be political here at Theta, but this, again, is evidence. They want to retain power. And if they don't get this under control, it's going to be tough. Now, last thing here. Bear markets. How deep are they? How long do they last? But remember one thing. Throughout everything that happens, and this is why we stick to our strategy, which we agree to buy high-quality stocks using a naked put strategy, which we get paid a lot of money on. Worst case scenario, we own that stock. We can wait for it to recover because things can and do get bad every so often. I've been investing, like I said, for almost 25 years. I've seen 3 of these, 02, 09, and 2020. And this is the 4th one. This is the one's pretty bad as well. It doesn't happen often, but you can see they do happen. So in my 25 years, I have now been part of 4 bear markets. They do not last forever. The markets have always gone to an all-time high, but we simply don't know how bad they get. Now, this one to me feels like, the market is, we're not in a major global recession. There's nothing like that, like 08, 09. That was global financial collapse. That was way worse than this is. In 2002, that was mainly tech-driven. Tech valuations had gone through the roof. And then, obviously, March of 2020, that was COVID. That was a very quick recovery. And now this one. So, is inflation coming down? That is the question. And it looks like the evidence suggests yes, it is. Why is that important for us investors? Well, once inflation comes down, the banks don't have to raise interest rates as much. And the stock market is going to love that. They're going to say, oh, great. We're looking forward 12 months. Now the cost of borrowing for all these companies is going to be less. If they have to raise money in the markets, it'll cost them less. Therefore, the profitability will be higher. And home prices should stabilize. Therefore, the consumer would return back to spending, right? What you don't want right now is out of control spending. So the Fed has to increase interest rates to bring inflation down. And what they're trying to do is something called orchestrated soft landing, where they land the economy in a very soft fashion, therefore not tilting into a major hard recession. Now, the Federal Reserve keeps saying there's a good possibility that the economy may not go into recession. We were in recession in the first quarter. Let's see what the evidence says for second quarter. But we can tell that inflation, evidence-wise, there are a lot of indicators looking like this will come down. And once the stock market gets wind that inflation is coming down, it could be a very good thing for the stock market. I hope you guys enjoyed this video, guys. If you have any questions, comments, we'd ask you if you could subscribe. And if you have any questions about what we do here at Theta, send an email to info@thetatradingco.com. Otherwise, we'll see you soon. Omar Khan from Theta Trading. Take care.